here we are, it's late February. The economy seems like it's starting to roll over. Things are slowing down. And of course, the stock market has had a couple of really bad days, and that's reflecting the fact that they're looking into the future. Now, the supply chains are certainly being impacted from China. The factories in China are slowed down, and of course, we're all globally connected. So is this the black swan we've been anticipating? Well, quite possibly. You know, these business cycles do not go on forever. They have a completion date, and when they complete, it's not so much fun. Now, the other side of the completion of this date is it starts over again. This is just the cycle that goes on over and over again. My timing model has said the U.S. housing would probably finish its correction the fourth quarter 2019 or the first quarter of 2020. And in the fourth quarter 2019, we saw a definite increase in housing. The green shoots had started. Remember, prior to that, housing had been down 7 of the last 8 quarters. And this last quarter has been very, very good. Now, I talked to Charles Nenner last week. Charles Nenner expects housing to slow once again. He's using Lennar as a proxy for the U.S. housing, and he shows it going down. Now, in looking at my model and looking at his chart, I realized that I didn't realize what I was looking at. I could see a spike in the middle, and we're going to have kind of a rare event, which is a double dip correction. Now, it's just a correction in the U.S. housing market. Now, keep in mind, the U.S. housing market is a completely separate asset class to stocks and bonds. In following with Charles Nenner a few weeks ago, he said mid-February we would have much lower interest rates. And of course, today we hit a record. We're down 1.33% on the U.S. 10-year yield. My goodness, that means 30-year mortgage rates really, really cheap. And of course, that's going to be a real positive for housing as a separate asset class. Once we get through with this slight correction, we're going to see housing take off, which is on my chart. Keep in mind, if you come out of the stock market, that money's got to go somewhere, and I think it's going to go into the U.S. housing. Now, here in Phoenix, we have a completely different set of rules. We're right next door to California. So Las Vegas and Phoenix, as you know, I've recently upgraded to neutral. We're not jumping up and down and saying we have to buy these things quite yet. We're still very yield conscious. We're very transactional conscious. We want a very good properties for our money. But the organic growth from these two markets is pretty phenomenal. And that's principally due to the fact that California has so many problems that people are leaving California and going to the neighboring states. Las Vegas and particularly Phoenix have lots of growth, lots of jobs here in Phoenix. We have lots of things going on for us, and it's multifaceted, and it appears to be a decade-long trend. So we're going to be getting both income and growth that's organic to general market principles across the globe. So here's what we're looking at. We think that probably housing around the globe is going to slow down fairly significantly. In the United States, we're going to see growth of housing probably slow as well. The great markets of the United States will still continue on a regional basis to grow, nothing like they were before. But once we're through this little bit of a correction, it's a double dip correction. It is a correction in an ongoing bull market. So that bull market should be pretty substantial in the outlying years. Maybe 2, 3, 4 years from now, we're expecting significantly higher prices. Now, how can that happen? Well, as Charles Nenner has shown us, we're looking at rates, looking on the outlying years being significantly lower. And of course, the response from the central banks has always been to throw money at the problem and to reduce rates. Now, if we start seeing rates in the United States for long-term housing rates for mortgages down into 1s or 2s, it's going to make payments very, very affordable. However, when payments go down, prices go up, and we're looking at significant price increases, which goes right into the model. It's amazing how these cycles work out. So here's our forecast. I think we have a significant slowdown in the economy. So we should all be prepared for that. Food in the house, water in the house, cash in the house, pay down our bills, and we're looking to take advantage of this slowdown. It is going to be a buying opportunity of a lifetime. Maybe one of the last times we can buy something and look back and say, that was amazing. I wish I would have bought more, because here comes your opportunity to do that. So if I can help in any way, please give me a call. We're here to brainstorm with you. We'll talk to your spouse. We'll talk to your accountant. We'll talk to your financial planner. Please talk to your financial planner anyway to find out what's best for you and where you should be positioned. And you really need to start maybe thinking of real estate as a separate asset class to start moving some of your risk portfolio into a much more conservative, consistent cash flow for yourself. So I'm here in Phoenix. If I can help in any way, just give me a call. My best to you.